Stock market has been going up recently. My unrealized days gain on January 12, 2023 was 2400, and for January 13 is 1200. So it has been going up because CPI data came out and it seemed to be okay, and that is surprising, and also it's a January effect. Usually in January, a lot of the portfolio managers, they started investing in stocks that they like, so there is a January effect where stock markets tend to go up in January. Today I'm gonna talk about two call options for January 2023. One of them gained 64.71% in 2 trading days, and another one 68.86% in 2 weeks. I'm going to tell you the differences between these two options and also the important features of call options. On January 13, S&P 500 jumped about 0.4%, Dow Jones 0.33%, Nasdaq 0.71%, Russell 0.58%. Russell is a small cap stock, so Nasdaq is mainly dominated by technology companies. S&P 500 is a 500 largest companies in US. So if you see gain of less than 1%, so that's a very quiet day. Usually when you see gains of more than 1% or maybe loss of more than 1%, usually there is a news. So there is a big news, good news, stock market jump. If it's a bad news, stock market goes down. So crude oil is now $80, so crude oil has been going up for the new year. Gold and silver has been going up because of the recessions, and 10-year bond is 1.8% jump. It stayed less than 4, and also Bitcoin is 20,000. It's because of the inflation. CPI data was okay. It wasn't so good, but it wasn't so bad. So people are expecting, next month CPI data gonna be better, and also possibly the Federal Reserve might pause interest rate sometime in this year, maybe possibly next year. So any good news in CPI data, any good news in labor market, unemployment rate, that's gonna help the risk assets like growth stocks, cryptocurrency, and the markets are expecting basically bad news, meaning that if there is a jump in the unemployment rate, or if there is a drop in the job openings, that's good news, because Federal Reserve is looking at the same data. They want to see how tight the labor market is. If the labor market is so tight, if the wage goes up more than inflation, whatever, that's gonna be bad for the inflation. So they don't want to see wage goes up a lot. So if the wage everybody is getting goes down, or maybe it just go up a little bit, so that's the good news for the stock market. And also the CPI data is the most important. The Federal Reserve wants to see the cost CPI data, so they want to see it going down. Their target rate is 2% inflation. So let's see. I don't think it's gonna happen this year. Probably in 2024 or 2025. Stock market sector. So you will see almost everything is green, and some of them are red, but overall it's a okay market. It's a very normal. It's not all green, it's not all red. For 1 week you will see technology has been basically going up quite a lot. Microsoft 6.36%, Amazon 13.99%, Tesla 8.26%, and healthcare is down, and consumer devices is down. Basically people are rotating money from this sector to technology setup. So this is amazing. Tesla, Amazon have been going up really quite nicely. And 1 month you will see the technologies are stay down. Tesla is down 23.95%, Apple is down 7.26%, Microsoft is down 6.8%. Healthcare, Pfizer, Johnson & Johnson, they are down. United Health, they are down. Energy has been going up for 1 month. Financials have been going up for 1 month. So what are the two call options that are traded in January 2023? Number 2 is BAC, basically on February 17, 23 expiry date, 23 strike price call option. It costs about 1.7, but one option represents 100 shares, so you multiply 1.7 with 170, you get 170, you pay 170.51, which is commissions, and you get this option. Then after that, on December 30th, basically within 2 days, 2 trading days, it jumped to 28.8%. Within 1 week, it jumped 68.86% gain. So it means if you invested $1,000, your money will have become $1,688 within 1 week. That's pretty good. But remember, the difference between these two stock options is BAC strike price is $33, EC is $115, so it's a big difference. And also the expiration date, BAC expires on February 17, EC expires on March 17. So the longer the expiry date, the more you need to pay. So you will see the price on January 4th, the price was 2.8 for BAC 33 call options expiring on February 17, but for EC on January 12, you need to pay $26.73 for call options strike price 115 and expiring on March 17. So the higher the strike price, the more you need to pay. The longer the expiration date, the more you need to pay for that. So it's really important. So basically BAC will be probably cheaper and EC probably will be more expensive. But what is most important thing is that if you believe that EC is gonna jump a lot within a very short time, more than BAC, then you should get EC. But if you believe that BAC gonna jump a lot within the shorter time, then EC, you should get BAC. So it's all about your predictions. What's your opinion? Do you think which one's gonna jump more? So if you have any question, comment down below, like, share, subscribe. Do you want to retire early? Do you love freedom? Do you want to work only 1 to 2 hours a day while traveling around the world and spend more time with your family? You can start stock investing and option trading right now. If you want to know more about finance, stocks, options, real estate, crypto, check out our playlist: stock investing, stock trading, option trading, real estate, cryptocurrency.